Good morning, everyone. Welcome to another episode of the Mizuho Week Ahead. I'm Boon Heng, market economist at Mizuho Bank. This week's theme is of parties and guests. Last week, US equities had a revival party from the AI valuation-led slump, with the Nasdaq rising almost 5%. Turning on the music, New York Fed President John Williams was very much the welcome guest as his dovish leanings towards a rate cut reignited expectations of a 25 basis point Fed rate cut in December, which now stands at around 82% according to Fed Funds futures. Kevin has said, though became somewhat an uninvited guest, gate-crushing the dollar resilience as reports of him being a front-runner to replace Fed Chair Powell engendered worries about Fed independence and dollar debasement risks. In Canada is still being held at the door of the trade deal party as trade talks have been stalled for almost a month. Canada also moved to add new tariffs on steel derivative products, and some of these products are imported from the US. That said, GDP outperformance boosted the Canadian dollar last Friday. In the UK, even as the Glades yield curve flattened on sight of tax revenue raising measures from their latest UK budget, the backloaded nature of tax hikes imply that the pound woes and front-end yields may continue to be buoyed even as the Bank of England looks set for another rate cut this month. In Japan, proceedings of the fiscal stimulus package prevented the yen from benefiting from lower USD yields and may be setting up bear traps. Meanwhile, in India, the authorities have rejected the IMF's assumption that 50% tariff imposed by the US will continue indefinitely. That said, there has been little signs of progress as cost of joining this trade deal party may not be palatable to all domestic sectors in India. Furthermore, with cheaper Russian crude providing direct import cost relief amid a vulnerable rupee, many issues remain thorny to resolve in India. Last Friday, India's Q3 GDP exceeded expectations on industrial activity, but was also on the back of deceleration in nominal GDP, with the GDP deflator even considerably lower than the CPI. While the 8.2% GDP print is admittedly an inconvenient optic for the RBI to cut, it is not a solid justification to deny further policy accommodation. For the week ahead, the RBI is having a compelling window of opportunity to ease policy rates even as rupee depreciation pressures remain top of mind. The current dollar slippage and falling inflation provide ample scope to lower currently elevated rates. Down under, Australia Q3 GDP is likely to print above 2% this week as investment spending rise on AI-led demand, while private consumption remain on a modest recovery path. The cheer, though, will be dampened by the recent CPI spike, which implies that the RBA is likely to remove the easing punch bowl just when the party is warming up. All in, as we enter Fed's blackout period before FOMC, activity and jobs data in the US will take center stage as markets ponder if US exceptionalism may pop the rate cut party or take the risk mode to new highs. For more information, please refer to our week ahead publication or contact your respective sales desk and RMs. And for regular notification on our market views, please subscribe to our channel and hit the notification button. Thank you.